manufacturing company based in Kenya operates a wholesale clothes shop in Zambia. The marginal tax rate in Kenya and in Zambia is 30% and 35% of net income respectively. Additional information is during the current financial year, the company incurred shillings 2 million on production costs. Operating costs in Zambia amounted to an equivalent of 6 million. Sales revenue from the wholesale shop in Zambia were shillings 24 million. Similar clothes imported by independent companies in Zambia would cost an equivalent of shillings 3 million. The company's management accountant advised that because of special controls of operations in Kenya and the unique approach used by the company when manufacturing the design clothes, the appropriate transfer price is 10 million. The company has the alternative of adopting either shilling 3 million or 10 million as the transfer price of the design clothes. Advise the company on the transfer price to adopt. You advise the company on the transfer price to adopt. So this question is on transfer pricing. The question is on transfer pricing. So we will need to have details here. Details. And then you will have it divided like this. We have transfer price. Transfer price being equal to shillings 3 million. So we have the supply division, which is Kenya. Then we have Zambia. And then we have the company. Then transfer price being equal to shillings 10 million. Shillings 10 million. So we have Kenya, we have Zambia, we have the company, Isa, you are saying you are not able to see? Is that so to everyone else? Except for this part. This part is reflection. If there is a part that has reflection. Everywhere else? Okay. The others, are you able to see? Okay, good. June says clear. Okay, Ivarin, it's clear. Good. So if it is clear, here's a chain. Good. So let us now start the recordings. So So I told you we begin with revenue, and revenue is the external first. External. So the question has not told us how much Kenya is making as the external revenue, but according to information 2, the revenue from the wholesale shop in Zambia were 24 million. That means Zambia is making 24 million here, and therefore the company will also make 24 million. And the same case will apply even on this side, 24 million and 24 million. 24 million, 24 million. Then we come and get the internal. Internal is the transfer price. I told you transfer price is a revenue to the supplier and a variable cost to the receiver. So when we charge at 3 million, Kenya will record a revenue of 3 million. We record a revenue of 3 million. And then this revenue here does not affect the company. Then on this side, when we charge 10 million, Kenya will record a revenue of 10 million. We record a revenue of 10 million. And it does not go to the company. So from there, we now say less variable costs. You less the variable costs. So the variable costs, we begin with the transfer. We begin with the transfer. So for the transfer, it is only affecting Zambia. It is affecting Zambia. So we give them 3, that is the amount they are paying, and it's not going to be felt by the company. Then Zambia here, when the transfer price is 10, they will feel 10, and it is not going to be felt by the company. The next issue is what we call the own production. Own production, according to information 1, we are told that the company incurred 2 million on production costs, and the operating costs in Zambia, there were 6 million. So here, Kenya will register 2, Zambia will register 6, and then the company will experience 8. The company will experience 8. And the same case will apply here. 2, then 6, and then 8. Then 8. That is what will happen. So from there now, we get the profit. We get the profit. We get the profit. So the profit here, let's call it before tax, because there is an issue of tax here. Profit before tax, this is 1. This is 9. This is 15. And then this is 16. This is 8. And then this is 8. And this is also, this is 16. That is 16. Then we get the tax at that 5%. Tax at that 5%. Tax at that 5%. So 0.35 times 1 is 0.35. Oh, sorry. I don't think I need to write that 5% because they are different. So delete here that 5%. Looking for my duster. Delete the 35%. This one is not applying to everyone. It's not applying to everyone. So in Kenya, tax is 30%. So 30%, it will be 0.3. In Zambia, it is 35%. So that 5% of 15 is 5.25. So here you add, you don't multiply, you add. So you add 0.3, and you should have 5.55. Then 0.3 of 8 is 2.4. Then 0.35 of 8 is 2.8. So plus 2.4, I'm getting 5.2. Getting 5.2. Then from there now, I should be able to report. Profit after tax. Profit after tax. Profit after tax, this is 0.7. That is 0.7. Then 15 minus 5.25 is 9.75. 16 minus 5.55 is 10.45. Then 8 minus 2.4 is 5.6. 8 minus 2.8 is 5.2. 16 minus 5.2 is 10.8. 10.8. So now, advise them, give them the advice on what would be the best transfer price. What would be the best transfer price? Advise them there and read the next question. Read the next question we saw. So I think, what have you advised them? They should go for which transfer price? They should go for which transfer price? 3 million or 10 million? $3 million or 10 million? Let me see your advice. Yeah, good. They should go for 10 million because you can see when they go for 10 million, they end up paying a smaller tax. So they have a profit of 10.8, which is higher than the profit of 10.45. So let's proceed to the next question. The next question. So this question is a decision theory question. And these guys are deciding on two options. One, it is either there is option 1 or option 2. Option 1 or 2. And this is either you no upgrade or you upgrade. And when you upgrade, there are two possibilities. There are two possibilities of membership. They can remain or they can increase. Members can remain or can increase. And then the variable cost also has two possibilities. The variable cost have two possibilities. And this one has just one possibility. So that means we will have 1, 2, 3, 4, 5. So we are going to have 5 tails. So that is the question of May 2016, question 3A. May 2016, question 3A is on decision theory. And being on decision theory, we will have payoff year. We will have payoff. No, I think this payoff we can have a working. This payoff, let me come up with the formula for the payoff. Let me come up with the formula for the payoff. Let us come up with the formula for the payoff. Instead of separating them, we combine them. So we have the payoff. And this payoff will be given as here we will have time in years. Time in years. Time in years. Times annual members, annual members, annual members, times cost per member, cost per member, cost per member. This one you subtract fee per member fee per member. So that is the formula that we are going to use in computing the payoff. don't know whether my space will be enough. Decision tree. So I need 5 items. So this is 1, 2, 3, 4, 5. So that is how we can design it. Once you finish drawing, you write drawn. Yes, June has finished drawing. Acheng has also finished drawing. Varin. The others, only 4 persons are finished drawing. Wengine yeah, good. So we can start now recording. We can start recording. We are told that the center has 4,000 members, and each member pays that 5,000. Each member pays that 5,000. So option 1 is where there is no upgrade. And that is the one that I've drawn here. So this one, you call it upgrade. This is upgrade. Upgrade. And here, no upgrade. No upgrade. This one is no upgrade. This is upgrade. My space is squeezed. If we go to option 1, we are told in this case, membership numbers are expected to fall to that 250 per annum for the next 4 years. Operational costs will remain at the current level of 4,000 per member per annum. So this is a case of that 250 members, and the cost is 4,500. And the cost is 4,500. So the probability here must be 1.0. That is the probability. There is just one occurrence. Then on this other side, option 2, if you decide to upgrade, you incur a cost of 18 million. So kuja hapa kwa upgrade, you put 18 in brackets. 18 in brackets. Then for the next 4 years, membership will be 4,000. So andika 4,000 here and 4,800. And the probabilities are 0.3 and 0.7. 0.3 and 0.7. Then the costs will be 6,000. So andika 6,000 and 8,000. So 6,000 is 0.4 here and 0.6. Then we have 6,000, 0.4, 8,000 and 0.6. And 0.6. So with that, let us now record the membership fee. The membership fee is that 5,000. That 5,000. That is not affected by whatever. Is that 5,000. That 5,000 and that 5,000. The cost per member, this one is 6,000. This is 8,000. This is 6,000. This is 8,000. And This is 4,500. The cost per member. $4,500. Then the annual members, this one will be 4,000. This is also 4,000 members. This one is 4,800. 4,800. And this one will be that 250. That's 250. And then the time in years, this project is taking 4 years. So andika 4, 4, 4, 4. So I want you to work out and give me payoffs in millions. Give me payoffs in millions. The first one. Work out and send me the figures. Okay, June says the first one is 464 million. 464 million. Yeah, I can see from Amanda, from Ivarin. Good. Give me the next one now. Oh, the next one is 432. I have 432. We go to the next one. $556.8. 556.8. 556.8. That is from Churchill. No one else has given me the figure. So yeah, it's confirmed by Atieng. So let's go to the next one. Yeah, good. Even June, Ivarin, good. The next one. 518.4. 518.4. Good. I can see the figures coming at a very high speed. The next one is what? $396.5. Good. 396.5. 396.5. So with those values confirmed, let us now proceed down there and have a working for the so we have the node, and then expected monetary value. expected monetary value. Expected monetary value. So let's start with node 1. Node 1, as you can see here, the lines moving out, they are complete. So what you do, you multiply. So utasema 0.4 times 464 plus 0.6 times 432 times 432. So give me the answer. Okay, June says 344.8. Someone else to confirm. 344.8. Yes, Acheng, Ruse, Ivarin, good, confirmed. Let's go to number 2. Let's go to number 2. Number 2, I will talk of 0.4 times 556.8 plus 0.6 times 518.4. 518.4. Yeah, it's June 5 at 3.76. 5 at 3.76. Yeah, I can see Varin, so giving the same figure. Isa, good. Let's go to number 3. So number 3, it will be 0.3 multiplied by what we have in number 1, 444.8 plus 0.7 multiplied by 533.76 minus, you can see there is a line coming in here which has a cost of 18. So that cost should be subtracted. So you subtract 18. You subtract 18 so that we get the answer. You subtract 18 million. According to June, is 489.072. 489.072. Someone else, yes, Amanda confirms that. Churchill confirms. You say, good. So that is okay. Then we go to number 4. Number 4 is simply 1.0 times 396.5. And the answer is 396.5. That is as good as that. The next one is number 5. When you get to number 5, you can see the lines that are coming out of that, they are incomplete. The lines are incomplete. So what you do, you select, and because there are 2 of them, you go for the higher. You go for the higher. So it is the higher EMV. It is the higher EMV at nodes 3 and 4. at nodes 3 and 4. So in nodes 3 and 4, the higher is 489. 489.072. 489.072. And that 489.072 has been identified from number 3. So you come here and mark like this. You put 2 strokes there, so that now you can offer the advice. You can offer the advice that the facilities should upgrade. They should upgrade. It is better to upgrade because they will make more profits. It's better to upgrade. Now, the next thing to naulizwa is the maximum price they can pay. So I have been saying, when you hear of the maximum price that can be paid, it is simply the value of information. It is simply the value of information. If you remember the question we had, the first question in this handout, we came across value of information, and there is a formula I gave you, or how I directed you on how to compute. And that is what happens when you are dealing with the single stage decisions. But when you are dealing with multiple stage, like this one, where there is a tree, the value of information is simply the difference between the best here, this is a mwisho, and the second best. The best and the second best. So in simple terms, the question was asking maximum price to pay. So the maximum price to pay for information, maximum price to pay for information, maximum price to pay for information. We have been saying that this is the value of information. And I'm saying this now will be the difference between 489.072 minus 396.5. That is the amount that should be paid. Give me that answer. $92.572 according to June. 92.9, no, 9 what? Or 572. 572. 572. So that is the value of information, and is the maximum price that the company should pay to acquire that information. So if we are okay with that, you can type yes so that I proceed to the next question. Okay, good. I can see the yeses coming. So I proceed. So we proceed to the next question, which is a question of May 2016. Question 4B. Ujuzi Limited operates a standard marginal cost accounting system. The information relating to product X, which is manufactured in one of the company's departments, is given below. We have direct materials, direct labor, variable overheads, additional information. Variable production overheads vary with units produced. Budgeted fixed production overheads per month amount to 1 million. Budgeted production for product X amounted to 20,000 units per month. Budgeted selling price per unit amounted to shillings 440. The actual results for the month of April 2016 were as follows. So we are given that. Now we are told in a columnar format, we prepare the original budget, the flexed budget, and the actual profit statement. The actual profit statement. So that question of May 2016, question 4B, is on what we call budgetary control statements. Budgetary control statements. So this budgetary control statement has 4 columns. And I want to go dividing the columns depending on the space each requires. So the first column is called details. So in details, there are 2 things that you bring first. One is units. The second one is percentage. Units followed by percentage. Then from there, you are supposed to bring sales revenue. Sales revenue. Then you say less variable costs. Variable costs. The first one is direct materials. Direct materials. It is followed by direct labor. It is followed by direct labor. And then we have overheads. Then when you do that, you get a figure we call contribution. You get a figure we call contribution. Then you say less fixed costs. Fixed costs. So according to this question, when you look at the actual in number 5, we have just overheads. We have just overheads, and then we will come to the conclusion with the net profit. With the net profit. So hiyo column ya kwanza inafika hapo. So hii itabidi ifungiwe. Hii inaweza funga yote. Hata hii ifungie yote. So the next thing is original budget, or what we call fixed budget. Fixed budget. Fixed budget is also known as the original. So for the units, we have, according to information according to information 3, they are 20,000. Maybe we can have our table figures in thousands. Figures in thousands. So to know the size of my column, I'm going to have it like this. I'm going to start here where my revenue will be the 20 times the selling price. If you look at information 4, selling price is 440. And because today my camera is a bit far from me, we will record 8,800. So that is the farthest that column will go. Remember, we have 2 other columns. 2 other columns. So what you do, you come back here, units, you say they are 20, and you assign them 100%. For the original budget, units are assigned 100%. Then for the costs, we start. Ukiangalia hapo kwa budget, material is 240. So utasema 20 times 240, 20 times 240 is 4,800. Then labor is 70. So 20 times 70 is 1,400. And 20 times 30 is 600. So if you go back there, say 800 minus 4,800 minus 600, you get a contribution of 2,000 shillings. And then, according to information 2, the fixed overheads are 1 million, so you put 1,000, and therefore the profit is 1,000. The profit is 1,000. So that is the original budget. haina mambo mingi. The second column or the next budget or the next thing you require is the actual results. Actual results. So starting with revenue so that we can know the space required. Ukienda kwa actual, you realize that we had 18,500. So utaweka 18.5 times the selling price of 480 times the selling price of 480. So 18.5 times 480, I'm getting 8880. 880. This one appears not very visible. So I'm saying it is 18.5 times 480. Those units that were sold, you multiply by the selling price. So hapa kwa units utakuja uweke 18.5. And then for the percentage you argue like this. If 20 units were 100%, 18.5 is what percent? Give me that. If 20 units represent 100%, 18.5 is what percent? Yeah, good. I can see the answers. So this one you simply say it is 18.5. You divide by 20, multiply by 100, and that is what you are getting, 92.5%. I can see those answers from Acheng, Churchill, June, and Ali. Good. So these are the figures you just copy as they are given in the actual results. For direct materials, it is 4426.5. Labor, it is 1299.4. Huyu mwingine ni 588. And the fixed down here is 1040. 1040. So sasa utasema 880 minus 4426.5 minus 1299.4 minus 588. I'm getting 2566.1 minus 10. Getting 1526.1. Are we in agreement at that point? Okay, June says yes. Acheng, Amada. So they're doing well. Now from there, we require the last column, which is called flexible budget. Which is called flexible budget. And flexible budget, Churchill, you say you are getting a different contribution. Anyone else getting something different from this one? Are we agreeing with this value, 2566.1? Okay, you can see the yes from June. The others, yes, Ching. Churchill, maybe recompute your figures again. Yeah, people are in agreement to this one. Tumechukua hii 8 namoa hii namoa hii namoa hii. Churchill, rework out the figures and you tell me whether you are agreeing. Churchill, are you agreeing? Okay, as we wait for Churchill to respond, we can be computing for the flexible. So for the flexibles, I told you, yeah, Churchill now is in agreement. That's good. For the flexible, I told you, anything that is variable, that is the variable cost together with revenue, you multiply them with the new percent, And the ones that are fixed, they remain as per the original budget. So doing that, I will come here and say, this 8,800, I will multiply by this percent, 0.925. 0.925. So I will say 800 times 0.925, and I'm getting 8140. I'm getting 8140. So that is the farthest my column for the flexible will get. And why do you do so? It is because these units of the actual, these ones, they are the ones you assign to the flexible. The units of the flexible are the units of the actual, and the same thing happens with the percent. So this one is 92.5. That's why we are multiplying with the percentage. So dancing the same rhythm, nitachukua hii 4800 multiplied by 0.925, nichukue 1400 multiplied by 0.925, nichukue 600 multiplied by 0.925, and up this 1000, I multiplied by 1.00, has not changed. So this one now, 4,800 times 0.925 is 4440. This one, 1,400 times 0.925 is 1,295. 600 times 0.925 is 555. So sasa ukisema 8140 minus 440, 1295 minus 55, I'm getting 1850, and this one is 1,000, so this is 850. So are we okay with that one? Good. Yes, Anne, June, Lucy. So then I seek to proceed to draw a statement reconciling the original budget profit and the actual profit. So this is now profits reconciliation statement. Profits reconciliation statement. Profits reconciliation statements. So I told you this one, we always begin with budget profit. Budget profit. And when we talk about the budget profit, it is the original budget. It's the original budget. So the original budget, we recorded 1 million. The one is tumekuwa nayo hapa, 1 million. Then from there, you do adjustments for variances. Adjustments for variances. Adjustments for variances. And I gave you a format that you should always follow. The only time we saw there could be a variation is if there is a running curve effect. But otherwise, you follow the format. Starting with sales price. Now, sales price, we say the formula is budget selling price minus actual selling price, you multiply by actual units sold. Budget selling price minus actual selling price, you multiply by. So according to our question, the budget selling price was 440. The budget selling price was 440, and the actual turned out to be 480. And the actual units sold, they were 18,500. So let me get the answer from you, and you tell me whether it is favorable or adverse. Yeah, Churchill, I can see your answer. And Jabi, good. Yes, Aching, good. So the results that I've seen so far, they are telling me it is 740,000, which is favorable. And that's okay because the selling price was more. That's why it is favorable. The next one is sales volume. Sales volume. So this one we say it is given as budget sales units minus actual sales units. You multiply by standard contribution margin. Budget sales units minus actual sales units, you multiply by standard contribution margin. So according to our budgets, we were supposed to sell 20,000, but we ended up selling 18,500. 18,500. And if you go to the budget we had, the contribution was whatever it was. Let me say that. If you go there, utaiona. Now tell me the contribution per unit, according to your budget, contribution per unit. Yeah, Churchill, I can see your answer. Some other people. I'm asking according to the original budget, what is the contribution margin per unit? Contribution margin per unit. Hey, goodness, your budget need to prepare. Here's a chain, can see that. June, good. Isa, good. Yeah, that is very good. In other words, those who have not gotten that, we had a contribution of 2,000, and this was for 20 units. That is how they are arriving at 100. That is how they are arriving at 100. Thank you, June. You have given the working. So now, give me the variance. The variance will be what? The variance. And you tell me whether it is favorable or adverse. What is the variance? Yes, and June, Achieng, good. So it is 150,000, which is advance. 150,000, which is advance. After that, tunasonga kwa huyu mwingine wenye anaitwa direct materials. Direct materials. Now, direct materials is given as standard material cost minus actual material costs. Standard material costs minus actual material costs. So standard material cost, you get it like this. You go to the original budget, and find that 1 unit was supposed to cost us 240. 1 unit was supposed to cost 240, multiplied by the unit produced and sold. Unit produced, let me confine myself to that. Unit produced, because there are times the units produced and sold are different. But this one is unit produced. So unit produced, you now minus the actual material costs. Ukiturn to the actual results, it was 4,426,500. That is what was incurred. So send me that answer. $13,500. Yes, Isa, Ann, June, Churchill. And you are disagreeing. Some are saying favorable, others are saying adverse. So that will require me also to compute so that I confirm 240 times 18,500 minus 44,26,500. That is favorable. You see, it's positive. Positive means this one is smaller. The actual cost is smaller. So that is good news. So those who are saying it's adverse, it is the reverse. So I think 13,500 favorable. Mwingine anaitwa direct labor. Direct labor. Now, direct labor we know again is standard labor cost minus actual labor costs. Standard labor costs minus actual labor costs. So, if you again run to where the budget is, you will find 70. So utasema 70 times 18,500 minus, you run to where the actual results are, you find 1,299,400. So then give me that answer. So June and Ann, I hope you have gotten the explanation. Okay, then I can see the results from June. Yes, Churchill. Yes, Achieng. Yeah, so all of them are in agreement. 4,400 advance. 4,400 advance. Let us now go to variable overheads. Variable overheads. Now, variable overheads is given as standard variable overheads minus actual variable overheads. Standard variable overheads minus the actual variable overheads. So what you need to do is to go to the budget and find that we had 30 per unit. So it is 30 times 18,500. Then ukibia kwa the actual results and find that we spent 588. So give me that amount. Yes, June, I can see your answer. Churchill, I can see that. I need yes and Ivari. Now in agreement that 3,000 advance. That 3,000 advance. Then we proceed where we now look at fixed overheads. Fixed overheads. So for the fixed overheads, I told you we have two of them. The first one is called expenditure. And the expenditure is given as budget fixed overheads minus actual fixed overheads. Budget fixed overheads minus actual fixed overheads. So sasa hiyo, it is our budget was 1 million. Remember that. Our actual turned to be 1040. So that must be a variance of 40,000, which is adverse. Which is adverse. There is another one called volume, but that one I told you, you only compute if there are stocks. You only compute that if there are stocks. But if there are no stocks, you don't compute it. So this question of ours does not have stocks, so you don't compute. And therefore, we come to the end of the statement where we record the actual profit. Remind me what we got in the actual results as the actual profit. In the actual results, what was the net profit? Oh, yeah, good. 1,526,100. Good. So you can reconcile that, and I told you you get budget profit. You add the favorables, you less the adverse, you check whether it goes to the actual profit. You take budget profit, you add Are they reconciled? Anne says yes. Churchill, yes. Farin says yes. Aching says yes. Amada says yes. Isa. Okay. So then I seek to proceed. The next question is May 2015. We are told the summary of financial information of Great Group Limited is as follows. Then additional information is capital employed at the end of the year 2012 amounted to that. Great Group Limited had non-capitalized leases valued at 16 in each of the years 2012 to 2014, which were not subject to amortization. I think that three should not be there. Amortization of goodwill amounted to 5 million per year in both years. The amount of goodwill written off against reserves on acquisitions in years prior to 2013 amounted to 45 million. Great Group Limited pre-tax cost of debt was estimated at 10% for both years 2013 and 14. The group cost of equity was estimated at 16% and 18. Target capital structure is given. The rate of taxation is given. The economic depreciation amounted to 40 million in year 2013 and 45 in 2014. The amounts were equal to the depreciation used for tax purposes and depreciation charged in the income statement. Interest payable amounted to 6 million per year in both years. Other than cash expenses amounted to. Now for the 2 years, estimate EVA. For the 2 years, we estimate EVA. So the question of May 2015 it was question 5B, and this is performance measurements. So in computing EVA, there is the formula that we use is the formula that we use, and because of the interest of time, I will just go straight. We will require a working here, which I will call here. Then there is a formula you know so well, written as KE times WE plus KD times WD times 1 minus tax is equal to what? Hiyo inaitwa nini? Let me see. Hiyo inaitwa yeah, good. WACC. 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 So starting down here, we have the year 2013. We have the year 2013. I'm trying to avoid the reflection. In the year 2013, according to information 7, equity is 50%, and according to information 6, the cost of equity is 16%. So it will be 16 times 0.5 plus the cost of debt. According to information 5, the cost of debt is 10 times 0.5 times, according to information 8, tax is 30%. So give me that answer. June and Isa, you seem to disagree. Someone else. And now 4 people, 2. Wengine wanapata 9.1, wengine 11. Sasa wacha ni hesabu ni wangapi wengi. Endeleeni kuleta nione who are many, so that I go by that, or I also become a witness, where I will say 16 times 0.5 plus 10 times 0.5 times 0.7, 11.5. So those who have a different value, I already check. I'm getting 11.5, and it appears to be the one with many people. Good, June. Let's go to 2014. In 2014, the cost of equity is now 18, but the structure still remains 50%. The cost of debt is still 10%. The structure remains 50%, and the tax remains 30%. Remains 30%. Umepata ngapi? Yeah, 12.5. Naona umekubaliana kabisa 12.5. So 12.5%. So let's now draw economic value added statement. Economic value added statement. We have 2014, we have 2013, and we do have details. So as you know, we said we begin with conventional profits or conventional income. Conventional income is the income that is in the income statement. And I told you you can start with any. So for my purposes, I want to start with profit before tax, so that I have 96 here and I have 117. But you could start even with retained earnings. You could start with any, then you work appropriately. So with that, let's bring the adjustments. The adjustments. So the first adjustment that you can bring, now that we have begun with profit before tax, is the income tax. You should raise that. That is 29 and 35. So you see, if you began with profit before tax, then you would not have needed to subtract tax. That's why I'm saying you can begin anywhere. The next thing that you need to deal with is the information number 2. Information number 2, we are told there were leases that were non-capitalized. So if they were non-capitalized, they were then treated as current expenses and written off in the income statement. But you know, leases are assets, and in that case, fixed assets. So they should be capitalized. So what you do, you add back leases. So leases, you should add back an amount of 16 in each year. An amount of 16 in each year. The next one that will affect us is goodwill. So andika goodwill. Goodwill, we say it should be added back. So if you look at information 4, it says amortization of goodwill amounted to 5 million per year in both years. So that one should be added back because it was an expense that was subtracted. So you should add back goodwill. The next thing that will affect us, information 5, 6, 7, 8, those ones we already have responded to. Then information 9 talks of what we call economic depreciation, amounting to 40 and 45 in the years, and the amounts were equal to the depreciation used for tax purposes. So I told you when it comes to depreciation, there is what we call cost depreciation, which is the one used in financial reporting. If you come across cost depreciation, you are supposed to add it back. you add it back, and then you subtract what we call economic depreciation. I think for now, for the interest of time, you just cram that. That cost depreciation, you add back, and you less the economic depreciation. But in this question, we are told the cost and the economic depreciations, they were the same. So we will not do anything regarding depreciation because they were the same. Then from there now, we go to number 10, which says interest payable is 6 million. I told you interest should be added back. Interest should be added back. Obviously net of tax. Obviously net of tax. So if it is net of tax, we are going to add 6 times 0.7 and 6 times 0.7. So tell me how much is that? 6 times 0.7, that is net of tax. 4.2, good. 4.2, 4.2. The next thing that you need to add back is non-cash expenses. Non-cash expenses. These are expenses like provisions for doubtful debts, depreciation, and so on. You are supposed to add them back, 12 million here and 12 million. So when you add that, you now get a figure called revised profits. You get a figure called revised profits. So quickly give me for the first year, revised income, which I want us to call A. Revised income for the first year, niambie ni ngapi? Yeah, according to June is 104.2. Yeah, confirmed by Anne and Isa. Let's quickly go to the next one. Quickly give me the next one. According to Amanda, 119.2, 119.2. Let me see whether it's confirmed by Churchill, Good, and Achim. All right, let's proceed to the next part, which is called conventional capital. Conventional capital. Now, conventional capital, I told you we use the opening balances. Hata ukiangalia zile statement tunachoraga, tukitafuta kina return on the investment and residual, pale kwa return tunatumiaga ile opening book value, the opening. So, according to information 1, the capital employed by the end of the year 2012 was 279. So here you utatumia for 2013, 279. And then you go to the year 2013 in results there where you can see capital employed, it is 340. So this 340 is what you bring as the opening for 2014. From there, now you bring the adjustments. Now the adjustments, kwanza unaangalia hizi, whether they affect the balance sheet. So tax does not go to the statement of financial position. What goes is leases. So we have said leases should be capitalized. So we are going to add 16 here and 16. We are capitalizing that. The next one is goodwill. It should find its way there. Goodwill. And goodwill, we will get it like this. Ukiangalia information number 4. We are told the amount of goodwill written off against reserves on acquisition in years prior to 2013 amounted to 45. So utaleta hiyo 45, which was there before 2013, you add this one that was allowed in 2013. And that tells you you should add back 50. And you do the same thing for the next year. You bring 50, you add back 5, the one that has been allowed for that, and we have 55. Interest does not appear, so there is nothing else that will affect us. There is nothing else that will affect us. So with that, give me what we will call revised capital. Revised capital, and we designate it as B. The first year revised capital is how much? Yeah, 345. And 411. Good. 411. From there, we need to get what we call cost of capital. And cost of capital is given as WACC times B, and we can call it C. WACC so this one will be 0.115 times 345. That one I can also assist you now. 0.115 times 345 is that 9.675. And I can also get EVA. EVA will be given as A minus C. So nitasema 104.2 minus the answer. It is 64.525. Then we mwingine is 0.125 times 411. So 0.125 times 411 is 51.375. 119.2 minus the answer is 67.825. So if you have any query, you can raise it. And the time is already spent. So I want to take this opportunity to first say that that brings us to the end of the procs and the semester as originally determined, because without exams will be next week. And we are all aware that the exams have been postponed. Now, in regard to this semester that we are calling a semester today, I want to take this opportunity on behalf of myself and colleagues to say thank you so much for choosing Destiny Technical School to be your trainer. We don't take it for granted. We know there are many other places you could have chosen to go, but you freely chose destiny. We want to say thank you so much, and even for the marketing that you have been doing for us. We want to really hope that we have given the value for your money. We have worked very hard to ensure that we have prepared you so well. So if the exams were to be done next week, we have no doubt whatsoever that you are ready to sit for the exams. However, the unexpected came. The unexpected came. And I advise you to, if you are not able to attend our prayers today in the morning, you can take time and listen to the recordings that were done. The speaker was talking of how do you handle the unexpected. It is very, very important to take time to deal with that. The unexpected has come and we must accept it. So from our end, we have organized for a special revision program that will take the next 3 weeks from Monday all the way to 15. And the objective is to ensure that you people, you do not lose the momentum that you had gathered in preparation for the exams. Remember, they also say that out of sight, out of mind. So if you relax, there is a high possibility of forgetting. And remember these things I keep on telling you, this is cramming. And cramming, I told you, inaitwa running, and you forget anytime there is a break. Bado hujafika kwa experience, so you should not lose momentum. So, however, this program will come at an extra cost to you of 5,000 shillings for the 3 weeks. I've seen some people suggest that the semester was supposed to end in May, and surely that does not apply. The semester was supposed to end at this point, and we have done what we were supposed to do. And going forward, we need to pay something small so that we can be able to facilitate the lecturers. Actually, I'm the one who costed that price, and the only cost I have factored is the lecturing fee. I've not factored anything to do with electricity, internet, and so on. So that is the lowest fee that we could be able to charge. And from a very sincere perspective, the class will only be offered if we meet a minimum number of students. If the class, I have been teaching you about routine decisions, and this is the one that is going to apply. If the class will be able to pay for the incremental cost of lecturing, we will offer. But if not, we will not. So that cost is not too much. And look at it as if the 5,000 will help you pass the exams, why not pay? Why not pay if it will help you pass the exams? So we want to encourage you, if you are in a position to pay, pay so that you proceed. But if for whatever reasons you are not able to pay, we also take this opportunity to wish you all the best and to wish you great success and to hope to see you in our section 6. But I really hope that all of us, we will be able to reorganize our expenses here and there and be found back to class on Monday. Thank you so much. Let me stop at that juncture so that I can use the few minutes remaining to curfew time to be in the house before it is 8. Thank you so much. God bless you. Thank you, June.